Are you prepared for the next global financial crisis? Beware, banking fires could be the spark that ignites it all. Welcome to today's video, where we will be discussing a topic that is of great importance to us all: the possibility of another global financial crisis sparked by banking fires. Over the years, the world has seen several financial crises and have left many individuals and organizations struggling to recover from the devastating effects. The most recent was the 2008 financial crisis, which left many people in debt, unemployed, and uncertain about their future. Now, more than a decade later, there are growing concerns that another financial crisis may be on the horizon, and this time it could be triggered by banking fires. In this video, we will explore what banking fires are, their potential impact on the global financial system, and what we can do to protect ourselves. What are banking fires? Banking fires refer to a situation where a large number of banks are at risk of failing due to a common cause. This can be due to a range of factors such as a sudden drop in asset values, a liquidity crisis, or an economic downturn. When several banks are at risk of failing simultaneously, it can trigger a chain reaction that spreads throughout the financial system, causing widespread panic and uncertainty. The potential impact of banking fires on the global financial system. The impact of a banking fire on the global financial system can be severe and far-reaching. Here are some potential impacts. Number 1. Economic downturn. A banking fire can trigger a recession or depression, leading to significant economic downturns that can affect multiple industries and countries. This can result in a decrease in global economic growth and an increase in unemployment. Number 2. Contagion effect. A banking fire can lead to a contagion effect where the failure of one bank can lead to a loss of confidence in the entire banking system. This can lead to a run on banks and liquidity crisis, where banks struggle to meet the demands of their customers. Number 3. Financial instability. A banking fire can also lead to financial instability, where investors and depositors lose confidence in the financial system. This can lead to a decrease in investments and a decrease in the availability of credit, which can further exacerbate economic downturns. Number 4. Global financial crisis. A banking fire can trigger a global financial crisis, similar to what happened in 2008. This can lead to a widespread loss of wealth, decreased economic growth, and a decrease in consumer and business confidence. Number 5. Geopolitical instability. A banking fire can also lead to geopolitical instability, where countries may become more protectionist and engage in trade wars or other forms of economic retaliation. This can further exacerbate economic downturns and lead to political instability. Number 6. Regulatory changes. A banking fire can lead to regulatory changes, where governments may impose stricter regulations on the banking industry to prevent further crisis. While these changes may be necessary, they can also lead to increased costs and decreased profitability for banks. What factors could spark a banking fire? A banking fire can be sparked by a variety of factors, ranging from economic to political and regulatory. Here are some of the most common factors that could trigger a banking crisis. Number 1. Economic downturns. A significant economic downturn, such as a recession or depression, can lead to a drop in asset prices and increase in defaults on loans. This can result in significant losses for banks and lead to a liquidity crisis that could trigger a banking fire. Number 2. Asset bubbles. Rapidly rising asset prices, such as those seen in the housing market prior to the 2008 financial crisis, can create an asset bubble that eventually bursts. When this happens, the value of assets can plummet, leading to significant losses for banks. Number 3. Financial innovation. The financial industry is constantly innovating, creating new financial products and instruments. However, some of these innovations can be complex and opaque, making it difficult to understand the risks involved. If a large number of financial institutions are exposed to these risks, it can lead to a banking fire. Number 4. Cyber attacks. With the increasing reliance on technology, cyber attacks have become a significant risk to the banking industry. A large-scale cyber attack on a bank or group of banks could lead to a disruption in financial services and erode confidence in the banking system. Number 5. Political and regulatory risks. Changes in government policies or regulations can have a significant impact on the banking industry. For example, if a government imposes capital controls or freezes assets, it can lead to a liquidity crisis and trigger a banking fire. Number 6. Geopolitical risks. Geopolitical events such as wars or natural disasters can have a significant impact on the banking industry. For example, the global financial crisis was triggered in part by the collapse of the U.S. housing market, which was caused by a combination of lax lending standards and risky financial instruments. In conclusion, there are many factors that could potentially trigger a banking fire, and it is important for individuals and businesses to be aware of these risks and take steps to protect themselves. By staying informed about the financial health of the banks we use, diversifying our deposits and investments, and having a contingency plan in place, we can reduce our exposure to risk and increase our chances of weathering any financial storm. How can we protect ourselves from the impact of a banking fire? Protecting ourselves from the impact of a banking fire requires taking several measures, including diversifying our deposits and investments, staying informed about the financial health of our banks, and having a contingency plan in place. Here are some tips for protecting ourselves from the impact of a banking fire. Number 1. Diversifying deposits. Deposits in banks are generally insured up to a certain amount, but it is still a good idea to spread our deposits across multiple banks to minimize our exposure to risk. This ensures that even if one bank fails, our deposits in other banks remain safe. Number 2. Stay informed. It's important to stay informed about the financial health of the banks we use. This means regularly checking the bank's financial statements, ratings by credit rating agencies, and news about any potential risks or challenges facing the bank. Number 3. Use multiple financial institutions. Using multiple financial institutions for different financial services, such as banking, investment, and insurance, can also help diversify our exposure to risk. This ensures that even if one institution fails, our other financial services remain ineffective. Number 4. Diversify investments. Similarly, diversifying our investments across different asset classes, such as stocks, bonds, and real estate, can help reduce our exposure to the impact of a banking fire. This is because different asset classes perform differently under different economic conditions. Number 5. Have a contingency plan. Having a contingency plan in place can help mitigate the impact of a banking fire. This could include having an emergency fund, having access to credit lines, and having a backup plan for accessing financial services in the event of a disruption. Number 6. Seek professional advice. It can be helpful to seek advice from a financial professional, such as a financial planner or advisor, who can provide guidance on managing financial risks and protecting our assets. In summary, protecting ourselves from the impact of a banking fire requires taking a proactive approach to managing our finances. By diversifying our deposits and investments, staying informed about the financial health of our banks, and having a contingency plan in place, we can reduce our exposure to risk and increase our chances of weathering any financial storm. Banking fires are a real and significant threat to the global financial system, and there are several factors that could potentially trigger a crisis. While it is important to predict when or if a crisis will occur, we can take steps to protect ourselves and reduce our exposure to risk. By diversifying our investments, staying informed about the financial health of the banks we use, and having a contingency plan in place, we can increase our chances of weathering any financial storm that may come our way. If you found this video helpful, please give it a thumbs up and share it with your friends and family. And don't forget to subscribe to our channel for more informative videos about financial topics. Thank you for watching, and stay safe.